A quick search for trading advice often returns a very specific vision of success: high-speed blurs of luxury cars and neon cityscapes. This lifestyle marketing works to instill a money-first mindset before you ever see a single price chart. But the names associated with actual longevity, people like Martin Schwartz and Paul Tudor Jones, don't appear in glossy ads. They built their success on a foundation of quiet, strict discipline that looks nothing like the modern influencer's highlight reel. Behind the flashy imagery is a specific incentive structure. Market makers profit from your bad entries, brokers often gain directly from your losses, and prop firms collect fees every time a trader fails their challenge. The industry thrives on a cycle of retail failure. To keep that cycle moving, they skew your perception of time and profit. The most common hook is the idea that 20% monthly returns are not only tossable, but expected for a beginner. The math of that claim quickly breaks reality. If you compounded a $1,000 account at 20% every month for 10 years, you would have over $3,175 billion. For context, that is more than 10 times the total net worth of Elon Musk. No trader in history has ever reached these figures because these returns do not exist at scale. Real professional performance is much more modest. A well-versed Forex trader typically averages between 2 and 8% a month, and that's including the months where they actually lose money. Success requires aligning your expectations with these professional benchmarks. By working within the boundaries of mathematical reality, you apply the principle of truth, rejecting the influencer's fantasy for the narrow margins that actually build wealth. Moving past the fantasy requires a shift in perspective. Consistent winners rely on an independent, logic-based confidence in their own process, regardless of what the rest of the market is doing. This is systemization. Professionals treat the market as a mechanical workflow, using a pipeline with set criteria for every phase. It begins with the testing phase. You must validate your strategy against historical data to ensure a statistical edge before risking live capital. This system provides a curriculum for the trader. It replaces gut feelings and emotional guesses with a step-by-step mechanical procedure that can be repeated day after day. As the trader Michael Marcus famously put it, if you can restrict your activity only to the specific types of trades your system requires, you can make money in any market environment. Without this mechanical framework, you cannot distinguish between a lucky month and a repeatable edge. Random decisions lead to random outcomes, making long-term consistency impossible. By operating as a disciplined operator of a statistical system, you remove the noise of discretionary trading. You stop gambling on movements and start executing a proven edge. Productive trading starts with a destination centered on the process. It requires the intention to become 1% better every single day through deliberate practice. This daily routine focuses on the right side of the screen, the process. You analyze your emotions, review every data point of a trade, and study the reasons why you chose to stay out of the market to preserve your capital. Without this intentional review, even a winning trade has no value. You cannot replicate a profit if you don't understand the specific logic and discipline that created it. Most of the market's historical greats reached this level through guidance. Paul Tudor Jones and Michael Marcus both learned their craft under the wing of seasoned speculators, adopting proven systems rather than guessing. Seeking a mentor allows you to skip the years of trial and error that typically wipe out a new trader. You step onto a path that has already been carved, avoiding the same financial pitfalls the pioneers faced. A true mentor provides a mental framework for independence. They are the opposite of signal services, which keep you dependent on someone else's entries and prevent you from ever building your own confidence. Real profitability is the compounded result of this structure, following a proven blueprint while maintaining a relentless focus on process-driven gains. The final barrier is psychological. Professional, systemized trading is functionally boring. It lacks the constant action that draws most people to the markets. This creates a dopamine trap. Many traders chase the rush of a live position rather than the tedious work of journaling and testing. They confuse a gambling addiction with a professional career. The principle of acceptance is what allows a trader to endure the inevitable losing streaks. You have to accept that mental exhaustion and financial drawdowns are the standard cost of entry. Adversity is the only guarantee in the market. Every blown account or failed trade holds the specific data you need to correct your system, if you are willing to look at it objectively. A winner is simply a trader who refused to cave when the boring work became painful. They kept showing up long after the initial thrill of the market had faded. While 95% of people will quit during these periods of hardship, these 5 principles provide the framework to push through. They are the tools the 1% use to stay in the game. Ultimately, success isn't found in a holy grail indicator. It is found in radical realism, mechanical discipline, and the sheer endurance required to treat trading as a professional craft.